Welcome. You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for May 29th, 2016. Market breadth. With this past week's market advance, our Bull Bear Point and Figure ratio at 1.39 rose from 0.95 last week and is now back in bullish territory. The total count of securities in bullish or bearish patterns decreased 1% to 2,853. The count of bearish stocks decreased 19%, while the count of stocks in bullish patterns increased 18%. The Pirls PNF Market Breadth Summary Chart shows us a market now one consecutive week in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. Those wishing to subscribe via email to the Pirls Stock Market Commentary free of charge on a weekly basis may simply enter email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 110 points for the 11th advance in 15 weeks. At a positive 51.34 points, it continues below all 6 highs above plus 100 and above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. Now at 201.46, the CCI 20 daily rose from minus 21.99 last week, now has 5 days above zero for a very likely change in Woody's trend next week, but is now outside the plus or minus 50 range for a valid zero line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 4 weeks ago, while the daily CCI 20 began a Woody's downtrend 3 weeks ago. Having begun a Woody's uptrend 3 weeks ago, the CCI 20 weekly rose to 85.79 from a positive 30.64 last week and from a positive 15.23 at the zero line reject pivot within the plus or minus 50 range 3 weeks ago. We will continue following the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive and 4 of the bottom 5 are negative. Summary: tech and banking on top, precious metals and REITs on the bottom. Bullish, semis, disk drives, and KBW Bank continue in the top 5. Brokers has entered the top 5. Gold and silver have entered the bottom 5. Oil has entered the bottom 5. Bearish, REITs continues in the bottom 5. Focus this week from www.zerohedge.com. In stunning reversal, IMF blames globalization for spreading inequality, causing market crashes. The following are some key points. In a stunning reversal for an organization that rests at the bedrock of the modern neoliberal, a term the IMF itself uses generously, aka capitalist system, overnight IMF authors Jonathan D. Ostry, Prakash Longani, and David Forseri issued a research paper titled Neoliberalism Oversold?, whose theme is a stunning one. It accuses neoliberalism and its immediate offshoot, globalization and financial openness, for causing not only inequality, but also making capital markets unstable. Among policymakers today, there is increased acceptance of controls to limit short-term debt flows that are viewed as likely to lead to, or compound, a financial crisis. While not the only tool available, exchange rate and financial policies can also help. Capital controls are a viable and sometimes the only option when the source of an unsustainable credit boom is direct borrowing from abroad. The IMF then goes full magic money tree and reverts back to a mode first observed several years ago, when it said that not only is austerity bad, but that unlimited debt issuance is probably good. Of course, what both the IMF and the magic money tree lunatics fail to grasp is that the only reason debt interest hasn't exploded in a world that has never had more debt, a process that inevitably ends in war, is thanks to central bank monetization of said debt and third-party investors front-running said central banks. Let's revert to the, quote, low costs of debt, end quote, if and when runaway inflation forces central banks to reverse what has been a 30-plus year process that started with the Great Moderation and will end either with helicopter money and thus hyperinflation, or central banks owning every single asset and thus the death of capitalism. The IMF's punchline, since both the openness and austerity are associated with increasing income inequality, this distributional effect sets up an adverse feedback loop. The increase in inequality engendered by financial openness and austerity might itself undercut growth, the very thing that the neoliberal agenda is intent on boosting. There is now strong evidence that inequality can significantly lower both the level and the durability of growth. And here is the IMF doing the unthinkable and waving to Marx. The evidence of the economic damage from inequality suggests that policymakers should be more open to redistribution than they are. What is the conclusion from all this? Perhaps that the push for global wealth redistribution and an end to conventional capitalism is in the works. How this transition takes place is unknown, whether by government decree, by regime change, by a paradoxically global government, one in which the IMF would be delighted to administer global monetary policy, to rein in globalization, or, simplest of all, by helicopter money, is still unclear. Whatever it is, something is coming, because for a stunning paper such as the one below to be published, it certainly had to be vetted, not only at all executive levels of the IMF, but was surely pre-approved by all legacy financial institutions. And that should be the basis for great concern. Thank you for tuning in for this week's Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart, compiled by Donald Pearl, www.pirls.com. www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant, relaxing holiday weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.